Gold isn't getting excited right now. Gold is being mechanically repriced, and the institutions that usually dampen the move are running out of clean ways to do it. The headline everyone's arguing over is that $6,700 by year end sounds insane, like a thumbnail number designed to farm clicks, and I get that instinct. But here's the part people miss. Big numbers done to become possible. Because everyone agrees with them, they become possible when the market's plumbing forces participants to buy at the worst possible time. And that's where the real pressure starts. Because the conflict in gold isn't bulls versus bears, it's paper structure versus physical reality, and it's risk managers versus a calendar they can't negotiate with. Stay with me, because later I am going to give you the only two pathways that make 6,700 even plausible. What level matters in the next couple weeks, and the one metric that tells you whether this is a controlled trend or the start of a squeeze that gaps over your stops. The mainstream will talk about fear, geopolitics, maybe inflation. Fine. But the hidden mechanism is math, and the catalyst is timing. You can feel it in how gold trades near extremes. Liquidity thins, spreads widen, and suddenly a move that should take months shows up in days because the market isn't debating value anymore, it's managing exposure. But that's not the part that matters. The part that matters is that we're in late January, and gold is coming into this window already priced like a market that has been quietly bid for a long time, not a market that just woke up one morning and got emotional. When gold sits near record territory, it changes the behavior of the people who actually move size, because in that zone, they're not thinking in opinions, they're thinking in limits. VAR limits, margin limits, duration limits, correlation limits, and career limits. And when those limits hit, trades don't unwind politely, they snap. That's why you can't treat near highs like a simple chart brag. Near highs is where the convexity lives, where options start dictating the tape, where hedges get chased, where every dip becomes a decision point for a fund that's underweight, and every pop becomes a problem for a dealer who's short gamma. And if you don't speak that language, the price action looks random. It isn't. It's structured chaos. So let's confront the $6,700 claim like adults. What does that number actually require? Not vibes, fuel. From current levels, it implies a move that's too large to be just retail buying coins, and too fast to be just miners hedging less. It requires a regime shift, or a mechanical spiral, or both. The two realistic pathways are simple to describe and brutally hard to live through. Pathway 1 is a macro confidence event that compresses real yields and forces capital into monetary hedges, not because people are scared, but because policy credibility gets questioned. In that world, the market stops pricing growth and starts pricing rules. And gold benefits because it's not someone else's liability. Pathway 2 is a positioning and hedging spiral where the paper market becomes the accelerant. Shorts get trapped, dealers hedge into strength, liquidity disappears, and the tape starts printing levels that would have sounded like fan fiction 6 months earlier. And here's the punchline. Those two pathways are not mutually exclusive. In fact, the most violent gold moves happen when macro gives you the story and market structure gives you the speed. Because if one level breaks, the math changes. Now let's talk about the hidden detail, because this is the part that makes, by year end, stop sounding like a random dart throw and start sounding like a scenario tree. The hidden detail is the calendar, not astrology, the calendar. Gold is walking into a pressure window where month-end positioning, policy event risk, and options exposure can collide in a very narrow time frame. Late January matters because liquidity is thinner than people admit, and because month-end is where funds rebalance, dealers reset books, and hedges get rolled. Add a policy week into that, and you get a market where everyone wants optionality and nobody wants inventory. That tension is what creates air pockets and gap risk. You've seen it before. Price trades calm for days, then one session does the work of 3 weeks. That's not surprise. That's positioning meeting a deadline, and the deadline is the kind you can't talk your way out of. It's expiry, it's settlement, it's funding, it's quarterly statements, it's mandate constraints. But that's not the part that matters. The next detail is what flips the whole setup. The people most incentivized to lean against a gold rally aren't only trying to suppress a truth, they're trying to survive a book. Think about who wants gold to behave. Producers who hedge future output want stability because volatility changes hedge economics. Dealers who warehouse options exposure want stability because volatility turns their hedge into a treadmill. Macro funds that are short gold as a risk-on hedge want stability because it keeps their correlations intact. Even central banks, ironically, like orderly markets because disorder creates political noise. So when gold starts moving in a way that threatens those incentives, you feel resistance, not always with the headline, often with the tape. Sudden sell programs into strength, sharp reversals around round numbers, a market that feels like it should go and yet keeps getting smacked. That's not proof of manipulation. That's proof of incentive. And incentives are powerful until they aren't. Because when the market pushes through the level that forces a different kind of risk management, the resistance becomes gasoline. Forced buying is real, short covering is real, dealer hedging is real, and none of them care what your opinion is. So let's pull the curtain back on the plumbing. Gold is not one market. It's spot, it's futures, it's options on futures, it's forwards, it's leases, it's ETFs, it's physical bars and vaults, it's refinery output, it's shipping constraints, it's collateral. The reason this matters is because the price can lie if you only watch one window. The truth leaks out through relationships. The curve, the spreads, the basis, the willingness to pay for immediacy. When the market is relaxed, the futures curve behaves like a textbook. Time costs money. So later delivery prices can sit above spot, reflecting storage, insurance, and financing. That's the calm world. But when the market is stressed, those relationships distort. You can see it in the curve flattening, kinked forward points, sudden changes in the cost of carrying metal, and a growing premium for certainty. This is where people throw around words like contango and backwardation as if they're magic spells. But the idea is simple. The curve is the market's opinion about time and availability. A stressed curve is the market saying, I'll pay you more to deliver sooner, or I don't trust future availability the way I used to. And when that happens in gold, it's not just a chart curiosity, it's a signal about liquidity and collateral and physical preference. And that's where the real pressure starts. Now zoom into futures structure, because this is where retail investors get tricked by a clean-looking spot chart. Futures markets are leverage warehouses. Open interest isn't just a number, it's latent energy. When open interest is elevated and volatility rises, margin requirements can increase. And that's when the market starts forcing decisions. Someone has to post collateral. Someone has to reduce risk. Someone has to close. And if that someone is short into a rising market, the closing is buying. Not buying because they're bullish. Buying because they're out of time. That's the difference between demand and forced demand. And forced demand doesn't negotiate on price. It pays up, it gaps, it chases. It creates the kind of vertical candles that make everyone swear something nefarious happened when, in reality, the plumbing just did what it always does under stress. But that's not the part that matters. The part that matters is options. Because in a market near highs, options stop being decoration and start being steering wheels. Here's the clean version. When traders buy call options, dealers often end up short those calls. If dealers are short calls, they have exposure to price going up. To manage that, they hedge by buying the underlying as price rises. That's delta hedging. Now the spicy part, gamma. Gamma measures how fast that hedge needs to change as price moves. When dealers are short gamma, rising price forces them to buy more and falling price forces them to sell more. That's pro-cyclical. It turns price movement into momentum. In a tight market, this can create a reflexive loop. Price rises, hedgers buy, price rises more, hedgers buy more. The loop continues until something breaks it. New sellers appear. Implied volatility spikes so high it chokes demand, or the price moves far enough that positioning resets. If you've ever watched a market feel inevitable for 3 sessions, that's often gamma doing its thing. And the opposite is true. If dealers are long gamma, they tend to sell into rallies and buy into dips, dampening volatility. So the question for this week isn't, is gold bullish? The question is, what shape is the options book? And does a move through a round number zone flip dealer hedging from dampening to accelerating? Because if this one level breaks, the math changes. Round numbers are not superstition. They're where strikes cluster, where stop orders cluster, where headlines cluster, and where liquidity providers get nervous. You can see it in gold around big psychological zones. The tape gets sticky, then it snaps. It pins, then it sprints. And if you're watching only daily candles, you'll miss the structure. This is also why people get emotionally destroyed in gold rallies. They buy after a sprint, panic sell on a shakeout, then watch it rip again. Not because they're weak, because the market is designed to harvest impatience. And that's where the real pressure starts. Now let's layer in paper versus physical, because this is where the skeptics of institutions perk up. And they should, but they also need to be precise. The claim isn't paper is fake. The claim is that paper can dominate price discovery in calm times because it is deep and liquid and leveraged. But physical constraints can assert themselves in stress times because delivery, availability, and preference matter. Physical stress doesn't usually show up as a flashing red sign. It shows up as friction. Borrowing costs behave differently. Delivery preferences shift. Premiums widen in pockets of the world where demand is real and immediate. Retail availability gets weird. Large bars get spoken for. Refineries run hot. Shipping schedules tighten. None of that means the market is out of gold in a comic book sense. It means the marginal unit is harder to source on the timeline the market wants. And when the marginal unit is tight, price can move a lot with not much headline drama. The key is divergence. When paper price is calm but physical premiums or borrowing tightness hints at strain, that divergence tends to resolve with price catching up. And if it resolves during a calendar window when liquidity is thin, it can resolve violently. But that's not the part that matters. The part that matters is who is buying and why. Central banks aren't momentum traders. They don't buy because the chart is pretty. They buy because gold is outside the system they don't fully control. It's a reserve asset that isn't someone else's promise. And over the last several years, central bank accumulation has been one of the most consistent structural sources of demand in the market. That kind of bid matters because it's slow, it's heavy, and it's less sensitive to short-term price noise. If a fund sells because CPI came in hot, a central bank doesn't care. Their time horizon is different, and their incentive is different. And incentives are everything. Then you have the fast money accelerant, ETFs and ETPs. When ETFs are in outflow mode, they can be a persistent drag because redemptions can lead to physical selling. When they flip to inflow mode, they can become a vacuum because creations require sourcing metal and that tightens the marginal supply. The ETF complex is one of the easiest ways for broad capital to express a gold view without touching futures. That's why ETF flows often correlate with price momentum. It's reflexive, price rises, interest rises, inflows rise, physical sourcing increases, price rises. It doesn't always work, but when it lines up with other signals, it's powerful. And that's where the real pressure starts. Now let's talk macro, but in a way that doesn't insult your intelligence. Gold doesn't need rates to go to zero. Gold needs the market to believe policy is constrained. The important variable isn't the Fed says X or inflation is Y. The important variable is the relationship between nominal yields, inflation expectations, and real yields, plus what the dollar is doing as a stress barometer. If real yields compress because inflation expectations rise faster than nominal yields, gold tends to benefit. If nominal yields fall because the market expects cuts, but inflation expectations don't collapse, gold can benefit. If the dollar weakens because global capital starts diversifying away from it at the margin, gold can benefit. But here is the nuance. Gold can also rally with a strong dollar in certain crisis regimes if the demand is about safety and liquidity rather than currency weakness. That's why you have to stop treating macro as a one-factor story. The macro pathway to $600-700 is not inflation goes up. It's a confidence event, a moment where the market concludes that policymakers are stuck between two bad choices, and the choice they make will erode real purchasing power or financial stability. That S when gold stops being a trade and starts being a reserve preference across different types of buyers. And if that coincides with a market structure setup that is already tight, the move can be far larger than reasonable. But that's not the part that matters. The part that matters is the transmission mechanism of an economic crisis. Crises don't begin when the news anchors use the word crisis. They begin when financing gets harder, when rollover risk rises, when credit spreads whisper before they scream, when liquidity in safe assets becomes conditional, and when correlations that people rely on start failing. In that environment, gold's appeal is not that it pays you. It's that it doesn't default. It doesn't get diluted by an emergency decision. It doesn't require a counterparty to keep a promise. And in an environment where the market becomes obsessed with counterparty risk and collateral quality, gold becomes a tool, not just a symbol. That is why talk of economic crisis isn't just clickbait in a gold narrative. It's a description of the kind of regime that forces large actors to hold different things. And large actors don't move gently. They move in size, on schedules, with mandates. The schedule part matters more than people think. Month end matters. Quarter end matters. Policy deadlines matter. Delivery windows matter. When the calendar forces action, you get price discovery, not opinions. And that's where the real pressure starts. Now, before we get carried away, we have to do the supply chain reality check. Gold supply doesn't respond quickly to higher prices. Mining projects take years. Permitting takes years. Capital cycles are slow. Refining capacity isn't infinite. Recycling responds somewhat to price, sure, but it's not a magic spigot you turn on overnight. There's also the reality that a lot of gold production is tied to broader mining activity, and even when prices rise, the extra metal doesn't just appear instantly in the form the market wants, where the market wants it. Logistics are real. Bar sizes matter. Locations matter. Vaulting matters. In a normal period, those frictions are background noise. In a stressed period, those frictions become the story. That MS, why the paper market can look calm while physical stress is quietly building, because paper trades instantly and physical moves on real-world timelines. And when real-world timelines collide with financial deadlines, you get the kind of move that people call irrational. It isn't irrational. It's late, but that's not the part that matters. The part that matters is the global picture. If you want to detect a real regime shift, don't just watch gold and dollars. Watch it across currencies. Watch it where currency stress shows up first. When gold is making new highs in multiple currencies simultaneously, it suggests a broader demand for the asset as a store of value, not a simple dollar story. When gold is only strong in dollars because the dollar is weak, that's a different signal. When gold is strong in dollars while also strong in other currencies, that's a bigger story. And when you see pockets of the world where physical demand is persistent despite price, that tells you the demand is less price sensitive and more necessity driven. This matters because global arbitrage links markets. If one region is paying up for physical and another region has paper liquidity, the arbitrage mechanism tends to pull price toward the higher value over time, especially when inventories are constrained or delivery is tight. People think arbitrage is some abstract finance concept. It's actually just incentives again. If you can buy here and sell there, you will until the spread closes or the friction becomes too expensive. In stressed times, friction becomes expensive, which means spreads can persist longer, which means the true price can migrate upward in steps. And that's where the real pressure starts. Now let's address the counterpoints, because this is where credibility lives. The easiest way to get wrecked in a gold bull market is to pretend it can fail. It can. A strong dollar impulse can cap gold. A persistent rise in real yields can pressure gold. A sudden risk on surge that pulls capital into equities and away from defensive hedges can cause outflows. Central bank buying can slow, either because they pause for optics or because they're waiting for better levels. ETF flows can reverse fast if momentum dies. And the curve can tell you the story. If the future structure steepens in a way that suggests funding stress is easing and immediate tightness is fading, that can take air out of the trade. Also, don't ignore volatility itself. Gold can whip around violently, even if the long thesis is correct. That's not a bug. That's how the market forces weak hands out and forces late entrants to buy high and sell low. So we need a clean lens for the next 1 to 2 weeks, because that's the time frame where you'll either get confirmation that this is a trend with structure, or you'll get the kind of rejection that tells you the market needs to reset before it can go again. Here's the 2 scenario frame you should use, because it keeps you rational. Scenario 1 is a controlled pullback and retest. In this scenario, gold does what strong markets do. It backs off from an extreme, it shakes out leverage, it tests the breakout zone, and then it either holds and rebuilds or it fails and tells you the move was too fast. The confirmation in this scenario is not, it goes up every day. The confirmation is that dips are bought where they should be bought, volatility cools without breaking structure, and the market starts making higher lows in a way that suggests accumulation rather than distribution. Scenario 2 is continuation squeeze and gap risk. In this scenario, the market doesn't give you the polite retest because positioning is too tight and the calendar is too unforgiving. It grinds higher, implied volatility stays bid, pullbacks are shallow, and then a single session, often around an event or a settlement window, launches price through a clustered strike zone, forcing dealers to chase hedges and forcing shorts to cover. The confirmation here is not a pretty chart. It's behavior. Rallies that don't retrace much, intraday dips that reverse instantly, and a feeling that the market is running away from sellers. The danger here is obvious. You can't assume you'll get filled where you want, and stops can become suggestions. But that's not the part that matters. The part that matters is levels, and I'm going to talk about levels in a way that doesn't pretend I know today's exact tick. You want 3 kinds of levels: the last major breakout zone, the most recent weekly high zone, and the big psychological round number zones where option strikes tend to cluster. The last breakout zone is the line in the sand where if price falls back through and can't reclaim it, you stop treating this as a clean trend, and you start treating it as a failed breakout that needs time. The recent weekly high zone is where momentum traders and CTA type models tend to add, and where failure can trigger de-risking. The round number zones are where the options geometry matters, where a push through can trigger mechanical buying. So the practical approach is this. If gold is above its breakout base and holding higher lows, the trend signal is intact, even if it's choppy. If gold loses that base and can't reclaim it quickly, the market is telling you the move is not ready to extend. It needs reset. And if gold starts pushing through round number zones with increasing speed and shallow dips, be aware that you may be watching gamma in action. Because if this one level breaks, the math changes. Now let's build the proof stack, because a single argument is never enough in markets. Proof point 1 is the chart structure. Are we in a breakout regime with higher highs and higher lows? Or are we in a topping regime with failed pushes and heavier closes? Proof point 2 is the curve. Is the term structure behaving calmly, or is it showing signs that immediacy is getting priced differently? Proof point 3 is positioning and volatility. Are implied vol and realized vol behaving like a controlled trend, or like a market where hedging demand is rising with price, which often signals stress? Proof point 4 is institutional flow behavior. Do you see signs of renewed interest from the broad pool of capital that uses ETFs and managed products to express views? And do you see the slow bid that comes from reserve preference staying persistent? Proof point 5 is physical symptoms: availability, premiums, borrowing tightness, delivery preference shifts, anything that hints at friction in the physical chain. Proof point 6 is global comparison: gold behavior across currencies and regions, not just one chart and one unit. When those layers line up, it's not proof of $6,100. It's proof that the market is in a regime where large moves become more possible. And possibility is what matters, because markets move on marginal changes in probability, not certainty. But that's not the part that matters. The part that matters is your psychology, because this is where most people lose, even when they're right. The market will try to use volatility against you. It will do it with headlines that arrive exactly when liquidity is thin. It will do it with sudden downdrafts that feel like the end of the world and then reverse in an hour. It will do it with end-of-week pinning, where price grinds into a level that makes you bored, then breaks right when you relax. It will do it with expert commentary that sounds confident after the move already happened. This isn't a conspiracy. It's a consequence of how stops and leverage work. Large players know where forced sellers live because forced sellers behave predictably. They set tight stops under obvious levels. They buy breakouts late. They sell when volatility spikes. The market doesn't have to know your stop specifically. It just has to know where stops cluster. So here's your shield: separate trend from noise. Trend is structure holding on higher time frames, key zones being defended, and macro flow conditions not deteriorating. Noise is intraday chaos, headline whiplash, and short-term overreactions around events. If your time frame is weeks or months, don't let a 1-hour candle bully you into changing your thesis. If your time frame is days, don't pretend you're a long-term investor when price goes against you. The market punishes identity confusion. Decide what game you're playing. And remember, price can whip around violently even if the thesis is correct. If you can't tolerate the whip, you don't deserve the trend. That's not macho talk. That's risk reality. But that's not the part that matters. The part that matters is what comes next. Because you're not here for philosophy, you're here for an edge. For the next week or two, watch 3 things like your life depends on it. Watch the curve for signs of stress or relaxation. It's the market's pricing of time and availability. Watch the dollar and real yield pulse, not as a simplistic inverse, but as a read on whether the market is leaning into or away from confidence. And watch how price behaves around the big psychological zones, because that's where options exposure tends to concentrate and where mechanical flows can kick in. If gold drifts higher with shallow pullbacks and refuses to give you the retest, don't ignore the possibility that hedging flows are supporting it. If gold pulls back into the breakout base and holds it cleanly, that's often healthier than a straight line up because it rebuilds structure and gives you a clearer line of invalidation. If gold slices through the breakout base and can't reclaim it, don't panic, but do respect the signal. It may mean the market needs to reset positioning before it can launch again. In that case, your job is not to marry a number like $6,700. Your job is to watch for the conditions that make a bigger move possible to reappear. Because if this one level breaks, the math changes. Now, let us talk about $6,700 by year end in the only way that isn't DT clickbait. As a scenario ladder with conditions. A base case path to something like that would require a sustained macro environment where real yields compress and confidence hedging grows combined with steady institutional demand and a market structure that remains supportive. Higher highs, higher lows, no catastrophic breakdowns and periodic resets that reload the move rather than kill it. This path is choppy. It includes scary pullbacks. It includes months where gold does nothing and then erupts. It's the grind and step path. The squeeze case path is different. It requires a trigger that forces rapid repositioning, a policy surprise, a funding stress, a sudden shift in risk appetite, or a breakdown in a correlation that everyone was leaning on. In that world, you can see weeks where gold does what it normally does in quarters. But the squeeze case path also carries the highest gap risk and the highest psychological damage, because it will punish both bears and overeager bulls. It rips, it pauses, it shakes, it rips again. It makes you feel late when you're early and early when you're late. That's why I'm not telling you $6,700 is guaranteed. I am telling you the market structure can create outcomes that feel impossible if you re-only thinking in linear narratives. And that's where the real pressure starts. So what's the clean invalidation? Not a random intraday dip. The invalidation is a structural failure. A breakdown below the last major breakout zone that doesn't 2T reclaim quickly combined with macro signals turning against gold. Real yields rising persistently, the dollar surging on confidence rather than stress, and flows reversing in a way that suggests the market's marginal buyer is gone. If you see that combination, you stop romanticizing the upside and you respect the reset. If you don't see that combination, and instead you see gold holding structure while the calendar forces hedges and rebalances, you stay humble, but you stay awake, because the market loves to move when everyone thinks it's too late. Now I want to bring it home with something practical. How you should think about positioning yourself mentally, regardless of whether you trade or invest. The mistake is to anchor to a single number like $6,700 and treat every wiggle as proof or disproof. The better approach is to anchor to conditions and levels. Levels tell you where forced flows change sides. Conditions tell you whether the environment is supportive. If you do that, you stop being the person who buys the top of a sprint and sells the bottom of a shakeout. You become the person who watches structure, watches flow, watches the curve, and waits for the market to show its hand. That's a different identity. It's not louder. It's not more emotional. It's more durable. And if you're the kind of viewer who wants to be durable, who wants to understand incentives, mechanics, and what to watch next instead of chasing the loudest headline, then you already know what this channel is really about. It's not about predicting every tick. It's about seeing the pressure before it becomes obvious. So here's your near-term checklist spoken plain. Watch whether gold holds its breakout base on pullbacks. Watch whether pushes through round number zones look sticky or explosive. Watch whether the curve and volatility behavior hint at stress building, and watch whether macro is reinforcing or fighting the move. If the market gives you a controlled retest, respect it. If it refuses and starts accelerating, respect that too, but understand the risk. Gaps happen when liquidity disappears, and liquidity disappears when the calendar forces everyone to adjust at the same time. That's why this week matters. That's why month end matters. That's why options matter. That's why the move, if it comes, won't feel like a slow debate. It will feel like the market suddenly can't unsee a level. And if it does, the conversation won't be, is $600-700 crazy? The conversation will be, how far does the forced buying have to go before it finds real supply? And that's where the real pressure starts.